Yeah, you feeling that, right? All right. Welcome to Vol Stars,
That
where
was
we talk
wild.
everything markets and those who make them. Today's episode is brought to you by Campbell's Alphabet Soup D-Gen Edition, now exclusively containing zeros, D's, T's, and E's. Also brought to you by SpaceX, by Tesla if you want to go to the moon. We are skipping straight to Mars. And finally, by GammaStrike.com, providing actionable real-time data for every type of trader. You've tried the rest. Now try the best. GammaStrike.com. All right. So before we get into the current macro environment, I think some introductions are in order. So I'm Jay Fresh, an engineering professor with an obsession for studying market mechanics, which some would say is borderline unhealthy. And I'm joined by Gherkin. Say hi, Gherkin.
What's up, everybody?
Who is I'm going to do my best here. If I get it wrong, it's
I'd
fine.
love to
Who's a
hear it.
professional trader going on about a decade or so now, is my best guess. Trading equity, stocks, options, futures, commodities, and some say his dignity as he runs a trading Discord community on the side. I'm also joined by Dork. Say hi, Dork.
Hi.
Who is a professional sound engineer with an eye for designing software and hardware both elegantly and efficiently, and making sure the trains all run on time deep in the guts of GammaStrike. All right, so we have quite a spread of technical, analytical, and execution know-how. And most people don't know this, but we have been basically doing this ourselves on a weekly basis for a few years now, just talking about markets to a limited audience, mostly because we love discussing the markets, but also actually mostly because we just love hearing ourselves talk. So we're kind of expanding this to a wider audience as our suite of tools at GammaStrike.com starts to expand and our reach grows. So, all right, let's get into macro. So, what's the first topic here? We got first topic is Mag 7 drops a lot today. What do you have to say about that? Let's start with our trader, Girk.
Well,
You're the trader. That's
I
all
did.
you'll ever be.
Yeah. Wow. I feel like you left out financial engineer and analyst,
No,
but
no,
all right.
you're none of those things.
It's fine. I'll live without the pedigree. I mean, I said vol was going to go up. I said it like a bunch every day
go
for
up.
like a week,
Yeah.
and vol went up. So
I bought an $80 TQQQ put and I made $60 on it.
you're welcome, Dork. I'm glad I could fund your next round of pork chops.
It was epic. I mean, I'm not gonna. It was a 3DTE TQQQ put that was like 2% out of the
Okay.
money. There was no way it should have gone up that much.
I want you to
All
know
right,
that
so-
I was entirely financially responsible for that trade.
Thank you for the financial advice, Kirk.
You're welcome.
Okay, so great. Vol it up. Why is it going up? Narrative always follows price. What's your best guess?
Oh, I simply think that like volatility is getting unpinned. Risk on had gotten a little thick, and I think like the short vol position was already decaying into the OPEX expiration. I think as that delta lifted off of the chain, there wasn't a whole lot of incentive to pile back into short puts when the market's just breathing all over 6,700. So yeah, I think we're seeing a little bit of risk off in the people that were kind of in the odd lot dates, and we're seeing a little less interest into piling into the call side. Bulls really pushed for like most of this morning and all of the day yesterday for the 6,700, and they didn't even get the little crossover. I think our high was like 66.99. And then yeah, vol just started picking up, and then we got some bad news out of Powell when he told everybody that whole big shocker, equities are overpriced. Who would have thought?
Well, okay. So I think people are underplaying that a little bit because we're kind of. I've been thinking about this a little bit. I think I was watching. What was I watching? I think it was. Was one of the late night HBO people. I don't remember. Anyway, it doesn't matter. But he had somebody on who was talking about this idea of like, I know, not John Oliver, the other one. Uh,
I don't
I
know any other
know,
names.
and you know, and I know that you know, and I know that you know that I know. Kind of this thing of like how culture shapes decision making in large systems, and sort of you have to reach this sort of emperor, yeah, Bill Maher, kind of this emperor has no clothes moment where it becomes impossible to ignore. And we've kind of been in this area of like, yes, everybody kind of knows that we're in a bubble and the Mag Sevens and this, crazy bubble. But it's kind of like, when does the pin drop, and who makes, who starts running for the door, and what facilitates that. And that's kind of like a, when does everybody know that the music stops? And I think when Powell actually came out and said, oh, markets are a little overvalued, keeping in mind that historically he's been saying, I don't like to comment on markets, like on the equity market. That's not my thing. Now he's making a comment about that market, which is signaling, hey, there might not be a Fed put waiting for you at the bottom of this, which was enough to kind of kick something off. So will it last a couple days, a week? Will it start a new trend, or is it going to be erased tomorrow?
Well, I mean, so the funny part is he says this, right? And I mean, maybe it would be par for the course for the market to react to that versus, say, the Schiller PE being at record highs, and your beautiful
It's
chart.
not at record high. Not at record high. It's very close, though.
Okay,
It
so
is,
approaching record highs, and you have household allocations to stocks, at record highs, and you have just you have concentration reaching record highs, if not at record highs. I mean, and it's been obvious for a while now. Yet, is this the thing that does it? Is when a regulator says something? I mean, that just kind of surprises me coming from a market that purports to be forward looking, doesn't it? I don't know.
Are you asking me? I don't know.
Yeah.
No, it was a rhetorical question.
Are you just musing?
Yeah, it was a rhetorical question. I'm just finding the irony in this whole deal. I mean, I think we've all kind of sort of ruminated on this being probably one of the most hated rallies in human history, if not the most hated, because at this point now, everything, I see it everywhere in pop culture, people talking about the AI bubble. Everyone's already talking about it, everyone and their mother. And yet we've continued to march up for the past few weeks, even with everybody knowing everything. The person shining your shoes is telling you it's a bubble. What does that mean? I don't know.
Yeah.
I found it interesting more than anything else.
Well, it's like the emperor has no clothes. And so if everybody knows it's a bubble, and everybody's talking about how it's a bubble, but it's still going up, what is the missing dynamic there? And I think that
Fear.
yes, and I think that's why it was such a big deal for Powell to make that simple statement. It wasn't even that aggressive. He's just like, I think it might be a little overvalued.
Right.
But just making that little statement is saying like, hey, I think it might be good for Fed policy if the market came down a little bit. And so that kind of signals to me that everybody's kind of saying like, yeah, it might be a bubble, but everyone's going to cuck out and bail us out the second anything goes wrong. So the only risk in the market is not being long enough, because if you are too long and it explodes, then you will get bailed out. But if you're not long enough, you just simply stay poor forever, right?
Let me
It's
be
like
clear. This is from an institutional standpoint.
Yeah. Yeah.
Yeah.
You personally are not going to get bailed out.
Yeah.
Yeah. No, you're screwed. You're gonna lose your house again.
Yeah,
If you
no,
lost
they'll
your
get
house
bailed out. You lose your job. Your stocks may
If you
go
lost
up,
your
but-
house in 2008, you're probably just gonna lose your house again because you learned nothing over the last 15 years. Okay, so a couple things I want to bring up that aren't on the list in terms of macro. So we have like this screaming stock market that's just going straight up. Everybody kind of understands we're in a K-shaped economy. I think there's a lot of discussion on that. Like 10% of people are spending literally half the money. So the wealthy are doing very well, and all of their assets are going straight to the moon. But then on the flip side, and Dork, I don't mean this as a personal offense, but the state of Nevada has
Wow.
officially released payrolls that are now negative year over year for the first time since the pandemic, and before that, the 2008 recession.
I mean, it makes sense because we're like the gambling and entertainment industry, is the biggest driver of our economies for the most part. So it makes sense.
I've been seeing all the pictures on the internet of the empty casinos in like Vegas and like South Lake Tahoe. It's bad.
Yeah, I mean, yeah, it's it's a disposable. What do they call that? It's a thing people do when they have money, and when you're tightening your belt, you don't go and you don't go gamble away $1,000 at a casino anymore. It's pretty clearly that's why Nevada's doing that.
Yeah. So okay. So I want to read another thing to you. This is from a very popular freight trucking person on social media, Craig Fuller. He says, trucking has been in my family since the 1960s. We've lived through multiple cycles: trucking deregulation, oil crisis, stagflation, the S&L collapse, Gulf War, September 11th, and the financial crisis. I've spoken to dozens of trucking veterans with 40 plus years of experience. Almost all of them agree this is the worst freight market in their lifetime.
Sounds about right. That's what tariffs do.
I mean,
Okay. So you
Yeah.
think this is mostly tariffs?
That, yeah, absolutely.
I mean, well, yeah, you think about it, right? The
The
volumes
tourism and the trucking, that's all tariffs.
Yeah, when you think about it, right? Like with tariffs like this, you expect the initial reaction to be get everything through while tariffs aren't in, and then once tariffs come in, we hold back and we wait, and so you're just going to see volumes fall off a cliff. So it makes sense.
Yeah, look at inventories. They're draining. They're not getting
I mean,
refilled.
yeah. No, everybody that I know, it's just anecdata, but everyone I know is like they're trying to keep their warehouse inventories like as unstocked as possible because the whole what the tariffs do is they throw a wrench in the whole the just in time system of manufacturing where the moment something rolls off the line in one factory, it gets put on a truck and shipped to the next one, and then it's like all a beautifully orchestrated dance. That's all kind of going haywire right now because you don't know what it's going to cost to do that anymore. You can't have that continuous flow because it'll get way too volatile.
My favorite thing about that is that like this lean manufacturing kind of push. I grew up educationally in that push, and everybody was all about Six Sigma and lean manufacturing. And then COVID hit, and everybody was just like, "Oh, if you do everything just in time, you have no buffer if things go awry.
If you
And
get a
things
once in a
can go-
generation's crisis, yeah.
and things can go very awry. But then, like, we got through it, and then everyone's just like, all right, we're going right back to lean manufacturing. No built up supply, no contingencies for any future shocks. We're never going to have another shock again. And
Yeah.
literally 5 years later,
I mean,
and everyone's
well,
just like, how could we have possibly prepared for
Well,
a,
the thing-
for
well,
a
it was-
supply shock?
we were especially vulnerable this time around because we didn't really ever fully recover from COVID in terms of manufacturing like that. Like what ended up happening was, you have, this company that makes, a little box with several chips in it, right? Those chips, now they have a bunch of these boxes being shipped, but the chips that are getting put in them could be made in factory A or in factory B. And so now when they have customer complaints, they need to know which chip was shipped with the device in order to make sure that it wasn't a problem with chips from factory B instead of factory A. And so it's a big giant mess. And so there was already a little bit of it was recovering, but it wasn't what it used to be, where it was like me and this guy in China were homies, we're doing everything as a link in a chain. Now it's like everyone's like a grab bag and everything, and now all that's also just been thrown up in the air. So now everyone's just reaching for dollar bills on the floor. I don't know. It's a terrible analogy, but yeah, it's chaos.
All right. So a couple other things that are going on right now in the market. First one is oil kind of popped today. I don't really have a good read on why that would be the case. I've heard some chatter that people think that oil is going to be the 2026 of gold in 2025 as people are looking to go long energy with the AI ramp up. But do you think today was a meaningful day or just noise?
I mean, we've had a lot of noise in oil lately. It's rate sensitive, obviously, on the FX side of things. It's a dollar denominated commodity. So we do have, you do have the reflexivity in prices due to drops or rises in like the dollar index. But a lot of the moves this week were on the Kurdistan pipeline headlines. And OPEC's been kind of unwinding all those voluntary cuts from 2022, 2023. And they're doing it into a backdrop that's already a little oversupplied. So there's probably some fear that in like Q4, Q1, like Q4 2025, Q1 2026, if those cuts continue to unwind, that we're going to see a bit of a glut. And in a weak enough dollar environment, obviously that can be a big problem. U.S. is a major oil producer, but on the other side of that, OPEC obviously doesn't like selling their fucking oil cheaply. And so there's a very
Neither
good
does the
chance
US.
that in the slightly longer time frame, like 3 to 6 months, we might see OPEC retighten. And that could add, not only another inflation shock for CPI, but, we could see oil move substantially higher if that were the case, especially with so much, Russian oil going towards China, and or if we continue to see pipeline disruptions, all of that, obviously could add a big inflationary tailwind to what we're still expecting, which is, kind of a medium term shock in inflation due to the tariffs. Well, the second round of tariffs, I guess, would be more accurate. So I think that's probably really interesting, especially with the rate cuts. Like, we've got the ECB down to their terminal rate at 2%. We've got the Fed cutting and the market implying, 5-6 rate cuts further out. And a lot of what's being priced in faster than even the Fed's dot plot. And so that's like a resurgence in oil pricing, which has been, largely in the $60 range, and has probably kept us from feeling any significant shock from tariffs, even though tariffs also drove down demand simultaneously. So it's hard to say, but I would say another inflationary shock from oil would be a really difficult dynamic for central banks. And obviously, with leverage so high and, margin debt running wild in, retail and institutional accounts, that there's probably significant risk in anything that would drive margin rates higher, or drive margin requirements higher. And obviously oil could do both of those things. There's probably a lot of fear surrounding it, and I think maybe that's why we're seeing such an overreaction from everybody to the small spike in oil we've seen over the last couple of days. It's not like oil's back over 70 a barrel or anything, but it's definitely scaring people, even with a move up to 63, 64.
Yeah, I think so. I mean, I think it cannot be discounted just how important it was when Joe Biden just sold off the strategic petroleum reserve back in the middle of 2022, and it just kind of broke the fever on inflation, which has never really revamped. Right, inflation has been slowly falling since then. I mean, it's been noisy now, but that's been kind of the scary thing for me, is that even if you are significantly dropping oil long term, you're still going above inflation, the inflation targets. I mean, there was some, like, oil was going down like 8% year over year. It was something ridiculous, and we're still over the inflation target. And as you all know, you can try to extract the effect of oil in the price of everything else, but it's very difficult to do. So when oil goes down, you tend to underestimate the inflation and everything else, because you're undercounting the effect that oil has as it permeates through the economy, right? It costs money to move everything across the country, and that's all baked into prices. And it's really hard to disentangle that. And so if oil goes up even a little bit, I agree, people are going to freak out, because we've enjoyed that tailwind for so long, and we're still above target, and things are starting to look bad. And so it's just kind of this sense of fear of, like, what can go wrong, what could possibly make this worse. So yeah, I kind of agree with that. All right, let's pivot to the last topic that we want to talk about. Trump has proposed that we end quarterly earnings and go to, I guess, whatever they want.
Well, he wants to do. He wants to do proposed biannual.
Yeah, biannual.
I mean,
event vol up.
Because I have an answer, but I want to hear your answer.
I'm going to let my bias show a little bit on this answer, because you can't not. It's just a political move. But he's already taken control of the BLS. He's done everything in his power to offset the realization and the data of the damage to the economy that tariffs are doing. And even though we see it in private data reports, we see it in PMIs, we see it in the BLS data released between, the period where he gained control, or started to gain control of BLS, and the beginning of the tariffs. I think this is just another way to push back that realization and that slowdown in growth. I don't think we're going to continue to experience the wild growth that we've been seeing. Again, everyone's talking about it being a bubble. The word's out there. So as that word spreads, that creates more fear. Am I overexposed to these assets that are very high risk and very overvalued? And that data would accelerate, I think, that realization. And so the longer we can push that back, the better. You also, inherently drop volatility in the market when you move to a biannual earnings structure, because you no longer have the quarterly cyclical volatility spikes on event vol for earnings. That now shifts out to being bigger spikes in volatility, but semi-annually, which changes a lot of market dynamics and hedging dynamics. And so, yeah, I mean, I guess you reduce pressure on short vol, which, obviously lots of large institutions are been piling into that hedge for quite some time. And then additionally, I think just a way to obfuscate the damage to the economy that has occurred so far. I mean, I personally think imports, exports are both way down. I think CapEx isn't really filling the void, and I think consumer sentiment is probably going to continue to tank alongside labor.
Yeah, I mean, I think that in terms of actual mechanical effects of it, I think that volatility is just going to go up, because
I agree.
Yeah, you have longer time frames of uncertainty, so you're just going to see vol increase. That's about. I mean, yeah, in terms of the implications or the the reasoning and all that, yeah, I think Girk hit the nail on the head. But yeah, for me, I just think that all the periods between the gigantic mega corporation earnings are going to be a little bit more volatile and a little bit more expensive.
Well, that's going to depend. I think that's going to depend on the earnings. Like, if the earnings are good, the 6 months between earnings, I think volatility is going to be very suppressed. But I think like if earnings are questionable or bad, or there's any doubt or worries as we push through the earnings cycle, that's gonna lead to like 6 months of much higher
I'm gonna put
volatility.
a little wrinkle in this for you. So one of the things that Trump has said was, if people still want to report quarterly, they can,
No
right?
one
So
will.
like, well, that's my question of like, if this is probably what's going to be a discussion in the C-suite is, if we don't report quarterly, which is what our investors have been used to for their entire lives, basically, if we make the decision to stop reporting quarterly and somebody else doesn't, who's doing well, does that make us look bad, like we're trying to hide something? And so there will be this push to say, okay, if we are doing well, we should report quarterly anyway to show people how well we're doing, which will cast doubt on other people. So it's kind of like a prisoner's dilemma. And so there's going to be this whole weird social dynamic that I think people aren't really thinking about, in terms of, why aren't you reporting quarterly if some other people still are, because they are trying to do their fiduciary duty to their shareholders, and they think that that's, given that they have always done it that way, that's probably the best bet. So I think, maybe I'm wrong, but I think there are those wrinkles there that people haven't fully worked through, which could be interesting. And so you could see the situation where we come up with, well, if everybody will just continue to report, and maybe the reporting will get shadier. I don't know. There's all sorts of outcomes that could happen from this, but none of them seem to be very good, because transparency is always good, and less transparency tends to be pretty bad.
Right.
um, Yeah, but yeah, I agree. I agree in general. I
Have,
think volatility must increase because information is less liquid, right?
have
It's
any of
harder
you
to get information.
guys ever worked like closely with an S&P or like a Fortune 500 company that was public,
How closely are you talking?
like with their boards or anything like that?
Not with their
In their
boards.
boards. Just
Okay.
in there.
Well, like the amount of time and effort required to report quarterly is actually, I mean, really inconvenient. I mean, you've got like the average 10Q is like 180 hours of professional big four accounting hours, and then at 400 $600 an hour or whatever it is nowadays. And then you've got your total audit fees, you've got um like Edgar and XBRL tagging, you've got press releases and webcasts and transcripts and Q&A prep that you have to do generally with a private company, and like they've got to come in and speak to like whoever's going to be doing the earnings reports and like get them prepped for analyst questions and things like that, which means time off of work for your COO or CFO or CEO, or maybe all three, as they prep for these events. And then um, the cost for most of those companies, not too bad, probably about 15 million a year to do it all, maybe 20 for bigger companies, or if they do like really big shareholder events like Nvidia or Apple or something like that, it can be a lot higher. But it's really just the effort put in, the man hours put into filing every quarter and announcing those earnings and having something to say and working with the accountants to make the books look good, and or as best as like make the books look as best as you can, and then working on what to present shareholders, and how are you going to project growth, and all of that is just it's a it's a lot, and it's disruptive if anything. So I could see the incentive for most boards being to just not report, as they will want to report as little as possible. Now, yeah, there's the transparency issue, but you have companies like Apple who don't want to tell their shareholders anything anyway.
Yeah, that's true.
And being able to tell their shareholders less, fewer times a year, even better. So I'm not really sure too many are going to be influenced by the current status quo.
Fair. All right. So speaking of earnings, we have a few. This isn't really earnings season.
Well, we're
but
at
we
the
have
tail end of it.
Yeah, we have a few earnings that are kind of notable for this upcoming week. I guess this current week.
Yeah.
Actually, we had
one tonight. Micron.
Yeah, I was going to say we had
tonight.
Micron tonight. How did that go?
Came in $3.03 adjusted. I think over 286 expected, and then 11.32 billion in revenue and 11.22 billion expected.
Okay,
so it's about
AI boom is still going going well.
Yeah. Micron shares have almost doubled in just the last few months. So they've been doing real well. They're the only U.S. based memory manufacturer. So when you've got 30% tariffs on South Korea, and you need RAM, they're going to be a much more attractive option.
Yeah, and they need lots of RAM for all these build outs.
Yep.
So yeah, I think it's no surprise that Micron has continued to do well, as you need this, so specifically for artificial intelligence type applications, you need to store a lot of information in RAM. So like, for example, even like the model, like all these LLMs and models and things that people are using,
big caching,
that all has to be stored in RAM so that you can feed your inputs in quickly and get outputs. And these models are massive, and so the more RAM you can have, the better. So it's kind of like it's almost like a move. I don't want to say a move away, but it is a readjustment of sort of the weights of like how much do you put on longer term storage, how much you put on RAM, etc. And I think we're moving a little bit more towards RAM. So it's not surprising that they did well. I think obviously the bigger question is longer term, now that everybody's calling a bubble, is when do people stop buying GPUs, which are largely influencing a lot of this RAM push. But yeah, I mean, for now the party rolls on. We have a couple of other earnings that are interesting here. So Costco is coming up on Thursday. Everybody loves Costco. Are they going to raise the price of the hot dog?
I don't think anyone actually cares about the price of the hot dog, but I will tell you that last week I talked about some anecdata where the Costco near me in New York City was empty on a weekend, which was wild.
I would just like to, I'm going to interrupt you really quickly to say that our producer Ron will burn down his local Costco if they raise the price of the hot dog. I won't tell you which Costco that is so that they all live in fear.
Don't eat those things. They're disgusting.
Disgustingly good.
They're not disgusting. Yeah.
Have you had their chicken bake? Their chicken
so
bake's
gross.
pretty good too.
All the food at Costco is foul. I can't believe you guys eat that. And
it's
if you
amazing.
Do actually eat it.
It's classic American cuisine.
What are you buying at Costco every week if you're not buying food?
I buy
chicken bakes,
and
that's food.
Yeah, no, but I don't eat any of the food they prepare. That shit's nasty.
Oh, the stuff just at the front counter.
Why are people eating that? I don't care if it's cheap.
I don't know.
Eat something
$10 pizza. I don't know. I'll eat.
It's not pizza. It's
I'll eat a lot of things for $10.
Sauce and cheese on it.
It's amazing, is what it is.
Ugh, Hicks.
I'm
I'll
interested
show you
in
amazing pizza, Dory.
I know you will.
So what do you think? Costco, good or bad?
I think they're suffering. I think their inventories are diminished. I think it's harder for them to sell because the selection has gone down. I think a lot of their profitability is on consumer discretionary goods, which they've been importing from China all along, and now they're not. And that makes it really, because they don't make a lot of money on food. Their margins on food are terrible. But they're and the food court, which you guys love so much, is a loss leader. So
That's because
why
the
they're-
food's so good.
that gives them what? Pharmaceuticals, household non-durables,
nutraceuticals.
and consumer discretionary items. And their inventory on consumer discretionary items is tanked because they sold out of all the stuff from China and they didn't order anymore.
Yeah. Can I just say their TV section looks like ass lately? Is
Mhm.
that something I can say?
Yeah,
in
those are all
public?
made in China.
It just looks terrible. It used to look like this dazzling thing that I could spend 2 hours in just drooling. And now I just want to get by it as soon as possible because it's sad.
Yep.
You know who?
Yeah,
you
so
know who
I
I'm
think
interested in?
Big miss.
Yeah. You know who I'm
And
interested in
that's-
seeing though?
Stitch Fix.
Yeah, Stitch Fix. No,
Oh,
CarMax. CarMax is going to be interesting.
I don't
Oh.
because they're a lender or because of sales. Sales are up. Car sales are way up for I mean, they always are in the summer. There's been shitloads of lease incentives. There's been tons of dealer incentives. CarMax doesn't really benefit from manufacturer incentives because they only sell used cars, but they do benefit from being a lender.
Well, but for in terms of seasonality though, we're going to see like year over year essentially, or comparing this year to last year, how things are looking. It'll give us a good idea of kind of where things are headed, I think. So I'm interested. I think it'll be interesting. So,
All
and
right.
BlackBerry.
So we've got BlackBerry. Yeah. Do they? I don't understand.
How do they
half of
exist?
these
What
on
do they
this
do?
list. Yeah.
They make like self-driving automotive sensors now or something.
Oh boy.
All that
boy.
matters, all that really matters, is maybe KB Homes, maybe CarMax, definitely Costco. Costco is macroeconomically significant.
Yeah.
And a huge bellwether for huge
Speaking
bell
of
end for
CarMax, how
consumer.
did AutoZone do today? Did anybody look at that?
They were right in line, I believe. I think they missed slightly.
Fifth straight earnings miss.
If AutoZone starts doing well, it's recessionary.
Yeah.
People don't
Well-
fix their own cars when the economy's good.
So what about Cintas?
What about it?
Because they do like uniforms and like
Eh.
cleaning
Yeah.
supplies and stuff.
So
Like
who works in offices anymore?
Yeah,
people
I
who
don't
work
know
in,
enough
I don't
about
know,
Cintas
factories,
to know like what it's really a
reflective
bellwether
vests,
for.
right? That kind of stuff.
You mean like safety gear? Didn't Trump?
Yeah, I mean,
did
just
Trump
all
get
that
rid of
shit.
OSHA yet?
Not yet.
No.
Yeah, we'll
Seems
see.
like a miss
All right.
on his part.
So, earnings is light. We've probably spent enough time talking about earnings. Let's go ahead to data this week and the week ahead. What do we got? What's worth paying attention to? Because
GDP,
there's so much
durables, probably the jobless claims. I think the market's going to be particularly price and like labor sensitive. So anything that shows any disruption in prices or labor are going to be probably significant for equities and probably the bond market as well, because even though the market's still pricing in like 2.5 or two more cuts from the Fed into the end of the year, those are really tentative, and a lot of the Fed speakers so far have been like, we think we might be a little bit soft on the rate, and obviously there's some really dovish ones, Moran, who are excessively dovish, but everyone else seems to feel like they may have gone a little bit under neutral into easing policy and not restrictive policy.
So I have some thoughts on Miron.
Moron? What about him?
Miron.
Oh, I'm sorry. I mispronounced it.
If you will indulge me, because this is kind of a bleed back to macro. But I did read a lot of what he had to say. He actually, in his last speech, he gave a lot of verifiable information and quantitative information about the position that he has made. Now, to be perfectly clear, it's still all BS, because a lot of it was centered around what he thought the current and future actions and current and future results from those actions, what effect that will have on R star, which itself is an imaginary thing that doesn't exist.
Mm-hmm.
And so he basically jumped through a lot of hoops to explain, the reduction in immigration and all of these other things are pushing down our star, and so we are too restrictive, which is, and keeping in mind that he said in 2024 that he thought we were too accommodating, or maybe it was 2023, I can't remember. I think it was late 2024. It was like right before he joined like Trump's team, and when he was still a non-biased source of thought. He thought that we were too accommodating, which he has now quickly transitioned to being too restrictive. And he gave a lot of reasons why he thought so, because our star is dropping because of all these things. But, he made it seem quantitative, but it wasn't really linked to any real, like, any real tangible thing. It was just like, oh yeah, our star's lower because of all these reasons. I don't know that I necessarily disagree with him. That I think that the policy of dropping immigration and increasing taxes on everybody through tariffs, I think all of that is quite deflationary, and I think all of that is going to quell growth. But that doesn't. It's gonna slow real GDP, but that doesn't necessarily mean it's gonna slow deflation. I guess or inflation is my point, because my current thought is, if you slow the real economy and you continue to spend like drunken idiots, then the economy is even less able to absorb your new spending with real productivity growth. And so you will actually increase inflation because you're just throwing good money after bad. And so I really strongly disagree with all the things that he said, but I will at least give him some props for trying to lay it all out there so that I could actually digest and criticize his position, because he gave it, versus like a J Pow or somebody else who's just throwing out aphorisms and good vibes. It's the vibe. I would like us to move away from vibe rate deciding, which is
vibe regulating. You don't like regulating on vibes?
Vibe regulation, yeah, which is where we've been for a long time. Now, I don't think he's going to move the needle on that. He's just, the Trump patsy that got pushed in to a pretty stacked board. But yeah, I thought all that was quite interesting from him lately.
So you want to know something funny, Jay Fresh? There's this part of me that thinks to myself that we should already be at a Fed funds rate of 3%. And the reason why has very little to do with the economy or inflation, and it has everything to do with banks. Because when you think about the real economy and how growth actually happens in the real economy, it's the growth of the money supply. And banks,
that's growing quite well right now.
Right. But banks are the ones who do that, right? And by keeping the Fed funds rate, the overnight lending rate, as high as it is, it sort of keeps them in this weird position where they don't really have a lot of the ability to they don't really have a lot of the ability to sort of do these sort of overnight financing things that aid liquidity and make credit even cheaper. So the back in, I think it was 2022 when First Republic broke in half. Was that right? Or was it 2023?
2023.
Yeah, right then I was like, the Fed should probably cut. Not stop tightening, but they should start cutting. And my reasoning was that, if banks run into more issues with liquidity and they need to get financing, it's just made all the more difficult by the overnight rate being as high as it is for those ultra short term
But this
loans.
is the insidiousness of inflation, right? I mean, if inflation wasn't such a big danger, right, they would of course love to always keep rates as low as possible, right?
I don't think it would have affected inflation like if that much.
Well, so we probably don't have time to go through this, but I have some thoughts that that the Fed's funds rate, where it is now, is actually stimulative, and dropping it will actually exacerbate issues with the long end and other things. So exactly the kind of things that they're trying to prevent, which is credit tightening. I think by no longer giving out free money with zero risk at the overnight rate, will require people to take on more duration risk to get the returns that they wanted to get, which will be an overall tightening. But that's something that we could certainly talk about later. So
that's kind of a medium term risk, though.
I don't mind your guys' arguments from a domestic perspective, but you've really got to think about monetary policy and bond markets on a global scale. And something Moran should have noted but failed to, because it would be counter to his thesis, was that increased tariffs on China removed the one thing that the Fed was able to rely on consistently, which is the deflator from Chinese PPI. As those costs came into U.S. importers, those were then realized on the consumer side. And so as long as China was deflating, U.S. consumers were benefiting by having cheaper goods, cheaper manufactured goods, cheaper I'm trying to think where it hits hardest, but this is dead space.
I will say, while you're thinking about that, that J-Pow even talked about that a little bit at the last meeting, where he even noted that, hey, in the long run, goods have been deflating, which have been sort of helping us stay below our 2% target, with slightly higher spikes in service in general. And so so just like we all need that oil deflator, right, and we really don't want that to become a headwind, I think it's the same thing with China. If that goods deflator, if that goods deflator also becomes a headwind, right, that's bad.
Yeah, I'm sorry. I just wanted to check what was covered under the Chinese tariffs, because it's been so confusing. But yeah,
nobody knows.
Machinery
it's impossible
and
to know.
Intermediate manufacturing inputs. So even on goods manufactured in the U.S. that are using sourcing most of their supply from China,
assembled in the USA,
assembled in the USA, manufactured here, but there's all their source goods and intermediate inputs are coming from China. That's still spiking even domestic goods. So, I mean, not only are we getting higher consumer prices on the domestic side, where we should be experiencing some relief from the tariffs, but we're also experiencing higher prices direct from China on consumer goods, and that kind of ties back into what I was saying about Costco. Is a lot of companies and retailers and wholesalers' response to this has been to just stop ordering stuff from China, which drastically reduces consumer selection and drastically narrows their inventory in a way that does not make consumers happy, because we're Americans and we want to be able to buy anything we want to buy, and especially that part of the economy, that 10% that's doing 50% of the spending. They don't want to be hindered by optionality, and so yeah, I think all of the Fed is kind of not really talking about that. I know JPOW has kind of hinted at it a little bit, but that dynamic only gets worse as the yuan pushes up against the dollar, and if they do cut and they ease more, as you were saying, Jay Fresh, and those top end rates do start to pick up a little bit, that's gonna drive the yuan higher against the dollar, and you're going to start to get an inflationary spiral to the upside on all of these imported goods. And we're already seeing that from Europe, where the euro and Great Britain, where the euro and the sterling have gone up significantly against the dollar over the last 6 months. I mean, you might not notice a lot because we don't get a lot of things as a consumer from Europe. Generally speaking, they're not a huge manufacturing base. I mean, maybe a few things, but if you look at like imported cheeses, imported wines, the stuff that we do get from Europe on a consistent basis, those prices are sky high, and that's the kind of thing that the people in the top 10% of earners are buying.
Yeah, I'll just say from my own experience, being in the great state of Texas, they basically banned us from buying anything from China, and so my costs have absolutely skyrocketed. So costs have gone way up for me as I'm sourcing American, and quality has gone way down. I can't tell you how many fights I've had with people. I've been haggling for price drops for like shoddy work. I feel like I'm buying stuff from a third world country. Like it's so bad. But anyway, all right. So we got about 8 minutes left, 10 minutes left. Let's get into some audience questions. So we've had some people who have submitted some questions to us about all sorts of things. So some of the things that people have asked about our service at GammaStrike.com, but also just various things about how market mechanics work. So let's get into it. This first question is very involved and requires, if you have not used our service, if you've never seen it, if you've never heard anyone talk about it, all of this will sound like Greek to you. None of this will sound like anything that makes any sense.
Pun intended.
Yeah. So, yes, pun intended. It will be Greek. So I'm just going to get into it. And the people that know, and the people that don't know, you can read our docs at GammaStrike.com/docs. There are several potential conflicting levels that I'm not sure how to interpret on the real-time data page. I find it confusing to know how to interpret between it being two levels of the same neutral with different timescales. E.g., if spot is above Vega neutral monthly but below Vega neutral weekly, so they're talking specifically about the SPX index, how should we interpret market maker behavior in these in-between zones regarding the particular neutral? So that's the first part of this multi-part question. So when you're between Vega neutral monthly but below Vega neutral weekly, what does that mean? What does that mean for you?
Let's first. I mean, I can kind of take this one. The first thing you want to probably discuss here is, what does Vega neutral mean? And Vega neutral kind of it's a little different than gamma and delta neutral, in the sense that this is dealing with volatility exposure, and it is not a second order. It is not a second order Greek. So much like delta, it is its own thing, and it's And what it kind of shows you is more of a representation of the market maker's P&L than it does the market maker's dynamic hedging exposure. And as you move above vega neutral, the market maker's profitability on their book becomes more concave. And so they basically they're losing money as price continues up above vega neutral. And if price is below vega neutral, their returns become convex and they become more profitable. And the distance of spot from that level determines the degree of how much the market maker is experiencing that effect. And so, in most situations, you have vega neutral on the monthly and vega neutral on the weekly, and one will generally be over or higher than the other relative to the amount of vega exposure on each chain. Right now, we've been seeing vega neutral weekly well above the vega neutral monthly levels. We haven't been seeing a lot of people willing to take on short volatility positioning on further dated contracts, not really since April. And it's one of the reasons VIX has remained relatively high during most of this period of time, is that people simply aren't shorting that window that VIX measures very heavily. They're shorting vol really aggressively in the short term, and the weekly, and the 10-day.
Mm-hmm.
We see, 10-day IV nosediving some days, and 10-day real historic volatility staying extremely historically low. And so you've got a situation now where vega neutral on the weekly maybe represents more concavity in the market maker's returns than vega neutral on the monthly does. But the market maker is still concave above both of those levels. Just the degree to which they are concave is obviously more extreme if you're above both vega neutral levels on both chains. But the effect of being above vega neutral is still there. It weakens in between the two, and then the market maker's book is fully convex when you're beneath both.
Yeah, and I just would like to say before we get too far into the weeds, credit to B Watts for this question, which is a multi-parter, and I'm not even done with it. But Dork, go ahead. What were you going to say?
I was just going to say that a lot of this discussion only really applies on SPX, SPXW, and the index funds, because the way that index fund options are traded is fundamentally different from the way that equity options are used. So with an equity option, you'll see vega neutral usually far below spot, and then with indexes, you'll see, and even with index funds, you'll see vega neutral above spot, and that just comes down to how they're used as hedging instruments for large portfolios, that kind of stuff. So
yeah,
you'll also throw that out there.
You'll also see that the market maker generally sells puts below vega neutral, and they sell calls above it. Because they're trying to hedge that vega exposure. And that's one of the reasons that you tend to get really strong trending price action above vega neutral, because the market maker has to continuously hedge their loss as price continues higher. However, if price begins to fall, the market maker can start dumping that hedge as their book returns to profitability, and so they're very inactive on the downside move. Obviously, that can get skewed a little bit by their gamma exposure, but for the most part, the market maker doesn't want to do a lot to support price action until they get back to a place where their book is profitable again. And that strengthens the downtrend.
And I think some simple dynamics, again, I think Dork said it correctly, that a lot of this is specific to index chains like the SPX, and honestly a lot of it is just the SPX, because that's where a ton of interest is built up. I mean, like no other. It's
how beta is defined.
It's the goat. It's the goat of options by a factor of 10.
It's literally because beta's defined by it. So like if someone wants to hedge their portfolio and they've got a beta definition, they literally buy puts on SPX.
But so I mean, the thing to remember is that in general, people go long Vega on the monthly and short Vega on the weekly, and so the market maker is net short Vega on the monthly and long Vega on the weekly, and so that's going to create all sorts of weird effects when their books flip from short to long on these various time scales, and that's what a lot of people here have been discussing. Is some of those dynamics, but a lot of weird things occur, and a lot of hedging behavior has to change in those different regimes. But let's go ahead and continue on with this question. So, can you extend the discussion to include the flip points, e.g., gamma flip?
Yeah, well, when we're discussing indexes specifically, I mean, the gamma flip is going to be king on intraday trading because gamma is highest on the 0 TTE, and it kind of rules spot. While from more of a macro or long-term swing trading perspective, gamma neutral on the monthly and weekly chains is very important for the volatility regime we're in, because market makers become kind of pro-cyclical when you fall below gamma neutral um, on those longer time frames. During the intraday, you have kind of like a more accelerated version of that realization. And so gamma flip on the intraday is like, as far as intraday trading goes, is definitely more important than the more kind of macro effect of gamma neutral on like crossing gamma neutral on an intraday.
I feel like it's a like a question of time scale mostly, right? Like ultra
Yeah, it
short
is.
term.
It
Ultra
is,
short term,
yeah.
it's definitely the 0 DTE and it's definitely the gamma flip. But like, yeah,
Brought to you by Campbell Soup.
but yes, the degen edition.
I've been waiting all night for that.
Yeah, no, it comes down to time scale, right? So like the same sort of principles apply. It's just that like the price scales and time scales are just extended when you talk about like our neutrals versus the flip points. When you talk about the flip points, you know, a trend can be, it is still pro cyclical. It's just that it's on such a short time frame and it can flip so quickly, like on a dime. So
Also,
versus
the
versus in a
effect
longer
of
frame.
crossing gamma flip on the intraday is very pronounced.
Yeah.
Gamma is, constantly increasing into close, and gamma on the 0 TT is the highest it's going to be pretty much anywhere else on the chain. And so that spot gamma is very, very important.
It's huge.
Yeah, Gamma's
It's
king on the
massive.
last hour of trading for
Yep.
sure.
It's so huge how much gamma is just piled into the contract, especially when
Yeah,
you're
you're talking
closing
about
near
like
a lot of
hundreds
OI
of billions of dollars of exposure that need to be realized within like 30 minutes, and in
or
situations like
seconds.
that, it kind of just is orders of magnitude more important than gamma neutral 3 weeks out or 4 weeks out or 6 months out.
Yeah,
And so while those levels are really important for the type of environment that we're trading in and understanding flows and how market makers are going to behave dynamically, it's not nearly as important for price action as gamma flip, delta flip on the intraday.
All right, so I'm gonna pivot really quickly, and I might just answer this by myself because we just don't have time to go through all of these questions from Solo, and maybe we'll include some of these questions in a future episode. Um, but a lot of their questions there's a common theme, and it sort of singles out liquidity, and if you have all of these large folks in the market who are holding large positions, how do they get in and out of them without causing market mayhem, where the size of their positions themselves cause chaos? And that's where liquidity comes
Kind of don't
into
know which one you're
play.
targeting there.
I'm kind of targeting all of them, and I'm going to try to say it in a way that is meaningful to
Probably
this
better
person.
just to answer them one by one because they are.
Well, how dare you? You just totally deflated me.
I'll
They're
just
totally
say the
Okay.
letter. I'll say the letter it's relevant to.
Okay. So, well, let's just start somewhere then. Fine. So, what does the market maker worry about most in the process of putting on or releasing hedges and risk assets? So, if we're talking specifically about options market makers, right, they have to be long or short the underlying to hedge their books. If we're talking about indexes, they have to be long and short both futures and ETFs and single stocks, right? It's a whole bag. But what do they worry about the most? And I think the thing to remember is that when most people trade options, they're not looking. I mean, nowadays, probably back in the day when options were actual optionality and not the actual market. But when people trade options today, they're looking for cash. They want more cash than when they started with. They don't give a shit about the stocks that those options are underlying, right? Um, and so cash settlement is king. And so what do you have to do to cash settle, right? And so the market maker, from that perspective, if all they have to do is make sure that everybody gets their cash, is they have to be able to buy and sell their massive amounts of hedging of their underlying, when the time calls for it. And in general, not a huge deal. But if you go to the GammaStrike macro page and you look at things that have a high delta to market cap, which would be down at the bottom. So things like Halo. I don't know what Halo is, but its delta to market cap is insane. It's like
It's because their market cap is not very high.
7. I don't know what Halo is, but is it a meme? Are people trading it?
It's a total meme. I don't think they are.
Okay, because it showed up for a while, and I just. Well, anyway, so you have things like XRT, IWM. These things are notoriously short. So like their delta to market cap is like 2, IWM is 1, CRE, which is regional banks, is near 1. You've got gold is pretty high right now. Anyway, so when these things are high, then that means the market maker is sitting on a significant amount of hedging on the underlying, and so when all of these things are said and done, either they have to transfer a bunch of shares or they have to buy and sell them at expiration. Typically, it is a mixture of both, and it can be, in general, it can be a somewhat predictable flow, although it can be hard to know because you don't know what fraction is bought or sold. So just because the total delta is high doesn't necessarily mean that the actual hedge is high, but they do tend to correlate. So, yeah, the market maker has really real repercussions in terms of how do they deal with all this. So, for example, XRT is notoriously often on the
Threshold list.
the threshold list for short sell, because the market makers on the options chain are so short that they're short more than what's in the ETF. So they're short more than 100%, which is fine. They have the right to do that, right? They're given carve outs for that, but yeah, these are issues that they have to deal with, but they tend to deal with them just by bleeding things off slowly when they need to, hoping that there aren't too many singularities in the market at big expirations and things. But this is why big expirations tend to be deep pinning events, because typically, so things like the SPX, if you're doing like a month an OPEX, like a quarterly OPEX, everybody's just like, okay, like the market maker's dropping $1 trillion of delta. We talk about that a lot. They just did that, 1.6 trillion. And it's like, what's the market going to do? Is it going to go nuts? It's like, well, no, because by the time you get there, first of all, the SPX is all cash settled, which is really convenient for them because all they have to do is just, when the trade expires, they've already hedged it all away. The money trades hands and they just move along, right? So, yeah, so there's not really a liquidity issue there for the largest instruments that are actually just cash settled. But yeah, that's what occurs. So they have to buy and sell the underlying, and they try to do it in a way that doesn't create too much chaos. But if you can pick up on times where there is a big imbalance, like perhaps on CRE in short order, because it's near 100% delta to market cap, there could be some weird things going on.
So I think I could take this a little higher layer, like a higher level, while maybe answering the question more directly. Because I think he's asking really specifically about like how a market maker functions. And like you could teach an entire college course on all of the things that a market maker needs to do in order to operate effectively on large instruments, like SPX or SPY or something like that. But I think the things they're most worried about, generally speaking, are going to be having to buy at highs and sell at lows when everybody else in the market knows that they need to do that. Um, and their footprint when doing that, and the fact that they have to signal to the market their inherent risk at those levels, which drives slippage, and then they get drift and Greeks that's not necessarily linear, and this kind of thing can really disrupt the market maker's ability to constrain the tails in their book. And liquidity is a part of that. Liquidity is like a really big part of putting on their hedges, and obviously they have like gap risk and discontinuity in illiquid markets that presents an issue. So the first thing that a market maker is really looking for when putting on a hedge is they're looking to create or find a venue in which they can establish a liquid foothold. Um, so they don't want the clients pushing them into more illiquid markets, and so they're going to try to spread out their hedge across multiple venues. Obviously, we all know about dark pools and block trades, and that's all a big part of that. But they're generally looking at futures first as the most liquid and deep market, and then cash down from there, which is going to be like your SPX type environment, and then even deeper, they're going to look towards ETFs and then maybe basket trades. But the further they get from that source, from that real truth in pricing and that deep liquidity, the more tracking error that they're going to have across their hedge, because spreads are just naturally going to widen the further you get away from the source. And so, I mean, a lot of that is mitigated through attempting to create create a prearranged environment where they have algorithmically selected parts of dispersion and correlation, and um, using skew on the surface to prearrange potential hedges before it becomes a risk. And so they were trying to front run where their risk would be in an environment that would be more liquid for them. And then, that also, same thing, benefits them when attempting to unwind those positions as risk increases into things like an expiration or into earnings or into event vol. And so, they're really kind of stacking the environment, and then letting everybody kind of run around on the chessboard that they've built.
Yeah, I'll add to this just very simply. Market makers don't mind changes in price, right? They're fine with that. They that is what they hedge against, right? What they are really sensitive to are big jumps, like really big instantaneous jumps in price. Those are very hard to hedge away. But if the market's just moving smoothly, even violently, but like in a continuous fashion in one direction or the other, they can hedge right along with it. And they'll either exacerbate it or they'll mute it. And that's like the whole point of what we track and why we care. Because of that effect.
Yeah,
But what they
the biggest
really
risk.
don't like are discontinuous jumps in price. So
Yeah.
like if a market's closed and then it opens and everything's like 1% off, like that's when market makers are like, oh God, what am I gonna do? I gotta
Venue
got a
risk is a big
little mini
deal.
crisis I
Halts and stuff
gotta
like
figure
that.
out. Yeah.
Yeah, I mean that's the
Um,
thing market makers are most afraid of is when they need to hedge, and everyone knows that they need to hedge, and the book is thin. That is the scariest moment for a market maker because they've got to basically tell everybody, and then they've got to fight against everyone to get that vol constrained, or allow it to expand, and the market is going to push back against that, and that's where things can kind of break a little.
Yeah. So so I'm going to speed run a little bit of this really quick because we're going a little long, which is fine because the discussion's great. But some people probably don't want to listen to us forever. But I'll answer some of these other ones from Solo really quickly. Is the current cycle healthy? No. During a bear market, how does one generally trade instruments without outright buying puts on everything? You generally don't want to just buy puts and hold. It's a high vol environment, not necessarily just like a straight down environment. So you want to trade volatility in a bear market. The next question is, what are the repercussions when current credit cycle explodes? What would be the value to buy after a large downturn in this scenario? Depending on how big this bubble gets, it's going to grow bigger than we expect. It's going to take longer to pop than any of us expect. But I think it's going to be more painful than what anybody's ever experienced. And this is my bear porn for the day. And I hope everybody will indulge me without criticism. I think it will be the biggest pop we've ever seen in our lifetimes, at least. And I don't know what to buy after that point. I'll probably wait and see. But there's such a big misallocation of capital that it's going to be nasty. And I hope it happens well after we've done our hard launch of GammaStrike.com before everybody is poor. All right, so new features. I think the only new feature to really talk about is one that we've been working on that we're really excited about, which is, I think we might have talked about it a little bit in the past. I can't remember, but historical data on real-time data. So what's happened over the last 30 days on the 1 minute time frame. With information, aggregated information from all of the options trading. So what's the put call ratio over that time? On the up to 1 minute time scale. What is the total cost of contracts traded, et cetera, for both puts and calls separated, and then net, and then also what are just like, where is the flip point, kind of that neutral type point for, gamma traded on those 0 DTEs and delta traded on those 0 DTEs. So I'm pretty excited about that. And if we have nothing else to discuss, we should move right into stupid bets. Ron, do you have that? Yeah.
What's our stupid bet?
I thought of it last week.
I think you did.
I should say last week, I remember, so I don't remember what your stupid bets were, but my stupid bet was something like J Powell wasn't going to cut, or he was going to raise, and that didn't happen. That was a really stupid bet, wasn't it?
Mine was that vol would go up. It did.
Yeah, there you go. That's not a very stupid bet.
Dork, do you remember what your stupid bet was?
But it seems stupid when we were rocketing towards all-time highs.
I think my bet was that we were going to cut by 50 basis points.
Oh, okay.
And also start easing. I was trying to get the dumbest bet I could. Okay, right. I can make a stupid bet.
Go for it.
We are going to see gold go below 3,600
Ooh. When?
in the next 3 weeks. Ah, shit, that's not long. That's too long, though. I got to do something
No,
that's going to happen in a
Yeah,
week.
it's got to be topical.
Shoot. Okay. Then I am going to make another stupid bet that Costco is going to beat
Ooh, there we go.
earnings and go above $1,025 within
I
the next week.
specifically predicted that they
Wait.
would miss on earnings. You bastard.
Wait, hold on, dork. We've got to put a sweetener on this bet. Cost of the hot dog, same or up?
Oh, shit. Okay, so we want to go even deeper. Okay, I'm going to say cost of the hot dog, same.
All right. That's a pretty reasonable.
I'm going to say
stupid
membership
bet.
price up.
Didn't they just raise it? I'm pretty sure they just did.
Yeah, they're going to need to.
You think you're going to do it again?
They're going to have to, because they're not going to sell
Oh,
anything. They're going
God.
to miss on their earnings.
Wait, are we all going to have to do a Costco stupid bet now? Are we all doing Costco stupid bets?
I mean, it's a hot topic, dude. I mean, this is the bellwether of the economy is see if families
Okay.
are still
It comes
buying
before
fancy-
you Consumer Reports, so
Yeah.
it's more interesting than durable goods. You want to talk about stoves and refrigerators?
Yes.
Costco sells those. Guess what?
Yeah. I don't know what I'm gonna bet for Costco. I don't know that I can make a Costco bet. I think you guys handled everything right.
No, I mean,
Well, I
there's
thought- no,
always
you were the hot
there's
dog.
always there's the earnings
threw the
hit
hot
where they
dog in
nail
the mix.
earnings.
Wait, you guys are gonna let me take the hot dog? I can have hot dog prices gonna rise.
Well, you pitched it,
All right, I'll take it. I'll take Costco hot dog
so
will rise by 25 cents.
Damn. Okay.
do we care about GDP? That doesn't matter.
No,
it's probably
Costco's
flat.
something
Made
that
up
matters.
anyway.
Flat.
Yeah. The only thing that matters
What about
is
PCE? Do you guys care about? Do we care about PCE?
No, okay. So I'll just say really quickly, I don't. It's really hard to get surprises on PCE
I know.
because it's largely based on data that's already come in, and everybody else has already kind of figured out what the basic calculation is. So I don't know. It's just really hard to get a surprise on it. I guess if you do get a surprise on it, it's really, really bad because
Yeah,
nobody
well, 'cause
expects
the
it. But
Fed's
then it's like,
deflated.
how did that happen? Yeah, no.
I want to
don't
see
care.
core PCE at 3%, right where
I
it
don't.
belongs at the long run neutral rate.
I don't. Please no.
the quote unquote R star,
Yep.
the very elusive
3.2. Well, you guys saw the
R-star.
dot plot. The R star is
Yeah.
3.25%, right?
Yeah, R
It
star
actually
has
is.
really high cheekbones and great skin.
I remember back
Perfect-
when we were calling
perfect
for
pitch.
a 3% neutral rate in like 2022.
Yeah.
R star's been my girlfriend for like 2 years, but you can't meet her because she goes to school in Canada.
Yeah.
Quebecois.
Yeah.
Yeah. All right. Well, it's been a fun 82 minutes.
Yeah, and if you guys haven't seen our service, check us out on GammaStrike.com and read the documentation.
That was nice.
Stupid bets. Stupid bets. Who's gonna win? Who's gonna lose?